Federal Reserve has continued its year-long fight against inflation by raising its key interest rate by 25 basis points. That is 0.25%. Fed Chair Jerome Powell announced the rate hike on Wednesday as he tries to slow down inflation while also avoiding any further banking turmoil and crashing the economy. Powell reassured Americans that the banking system is strong despite the failures of Silicon Valley Bank and Signature Bank. And for more on this, we're joined now by financial expert Mitch Roschelle, the managing director at Madison Ventures. Plus, he has a bunch of other titles, too, and you're going to see them on the screen. Good morning, Mitch.
Good morning, my friend.
So 25 basis points here. It might have been more if not for this recent banking turmoil. But also, Jerome Powell sort of signaled that the Fed rate interest hikes might be coming down.
Yeah, well, if they're coming down, it's because the economy is slowing too much, which, by the way, is the goal of raising interest rates. It's really interesting. You started the block talking about the stock market because after Jerome Powell spoke, the market was sort of neutral. Then it went up. But as the day went on, it went down, and it went down, significantly because I think they started parsing his words, thinking about what it meant. The goal of the Fed in terms of using its tools to combat inflation is to have the elusive soft landing of the economy. And I think when we enter this banking crisis as a consequence of the Fed's policy, I think that that's going to make it much, much harder for there to be a hard, soft landing. I mean, more likely a hard landing. And I think that's why the stock market took it on the chin yesterday, because they realized there's a reality that we could have a ugly recession ahead of us.
Well, yeah, I mean, the way we structure the show is we give you the stock futures up top, and then we'll give you what happened yesterday. But yeah, the green that we saw from the stock futures is not going to match the red we're going to see a little bit later from what happened yesterday. But we're going to get there. Speaking of the soft landing, though, they've been using that soft landing sort of metaphor for a while now. But to me, it's more like braking in a car, and it's like, if you slam on the brakes, your wife's going to smack you and be like, what are you doing? Like, you've just, caused my seatbelt to react and choke me. Can you drive better? They're trying to slowly come to an easy stop. And it just seems like that's not really going to happen here because they've been raising interest rates trying to get a hold of inflation. Now you have this banking insecurity that people feel, this lack of confidence in the system. And it seems like the interest rate is almost secondary now because people just don't feel confident in their money. And that's a huge problem for the entire economy.
I have two responses to that. One is this is completely a Main Street problem that's intersecting what I'll call a Wall Street problem. Main Street, I was checking out a CVS yesterday, a really nice guy in my community in Florida who recognized me from perhaps this or other networks.
Of course it was this, Mitch. You know it was this. Thank you.
Yeah, well, it was during the daylight, so I don't know. But he was a nice guy. He couldn't place me, but knew to ask me about this. And he's very worried about, whether or not his bank is safe. And I asked him where he banked, and it was one of the top 5 banks in the country. So that you have Main Street worried about whether or not a top 5 bank in the country is safe. Okay. The flip side is, and this is something that Chairman Powell said, and I tend to agree with it, if banks are concerned about their balance sheets, they're going to be much more conservative in terms of lending. And if banks aren't lending, we don't have the lubricant in our economy, which is credit. Credit's the lubricant in our economy, right? We are a borrower nation, whether it be individual credit or, more importantly, business credit, which creates jobs. So that's the reason why we're probably going to have that you slamming on the brakes and sticking your arm out like that so your wife doesn't go through the windshield.
Well, and you just mentioned that the Fed is slowing the rate hikes because it looks like banks on their own are going to stop lending, or at least stop lending as freely or as cheaply as they have in the past. And that's why, I mean, you emailed us before the show or last night that the Fed's 2-year outlook here is grim. But it doesn't come down necessarily to inflation or any sort of a pandemic or any sort of a systemic failure like we saw in 2008. It basically comes down to banks being afraid to lend their money to pretty much anyone. And you mentioned that as the lubricant of the economy. Thanks for watching. Go to newsnationnow.com to find NewsNation in your cable lineup. And don't forget to click the red subscribe button below to get more of NewsNation's fact-based, unbiased coverage.